everybody for joining us today. Again, this is Carl Streck, one of the co-founders over here at Mountain Seed. Always excited to have these calls. I know we've got many Mountain Seed clients joining today, and many folks that I like to say are not yet Mountain Seed clients. So really grateful for everybody. You know, one of the things that we try to do at Mountain Seed is to continue to add value to clients and prospects in the banking community in a variety of different ways. And so many times on this monthly webinar series, we host people that have nothing to do with appraisals or our current business, but just in an effort to make sure that we add value to our clients and the banking community. So with that, really excited to welcome Angel Oak. If you don't know Angel Oak, they have been kind of a friend of the firm over here at Mountain Seed for a number of years, but really experienced professional folks in investment management and fixed income and a variety of mortgage banking solutions and all kinds of things, but also creative folks. And from Angel Oak, we have Rob McDonough. Many of you probably know Rob. He's the senior consulting manager at Angel Oak. Has a background as chief risk officer of Angel Oak Capital Advisors, which is a registered investment advisor with over $6 billion in assets under management. He's also, and you know, you'll hear from him in a second, so you'll know his expertise, but is widely regarded as an expert in this field and asked to speak not only all over the U.S. but all over the world as well. And he's been formerly at the Federal Reserve, at Accenture, a whole bunch of places. So anyway, Rob, I'm grateful to have you. I think we did this together maybe a few years ago, so excited to hear the topic. I know a lot of folks are concerned about credit concentrations and CRE concentrations. If they aren't concerned about it, we've definitely heard from our clients that the regulators are concerned. And so I know that you guys have some creative strategies, so hopefully some folks on the call will get a lot of value on this. I will let everybody know that there is a chat feature on your GoToMeeting toolbar. So if you do have a question for Rob, I think there's chat or questions. I think there's both. Feel free to put that in there, and then if it's relevant at the given time during the conversation, I'll jump in and ask the question, but we will have Q&A at the end as well. So with that, I will turn it over to Rob.
Great, Carl. Thanks for that introduction. I appreciate it. Appreciate the opportunity to get in front of some of your clients and also maybe some potential clients as well for Mountain Seed. And you're correct, we did get together and do this once before on a different topic, but I'm excited to be here today to talk about some strategic thinking really around dealing with some concentration issues that I know a lot of banks, in particular community banks, are dealing with. So as we get started in this, I do want to reiterate that I hope this turns into a conversation as much as the technology will permit. And do feel free to submit questions and make observations as we go, and hopefully Carl can help me monitor some of those and jump in if there are some that are particularly relevant to what we're talking about at the time. If not, during the presentation, we can always, of course, circle back and get with you a little bit later. But in any event, let me just talk about what we have as an agenda today. We have a relatively ambitious agenda in front of us. We got plenty of time to do it in. Wanted to spend a little bit of time talking about what Angel Oak is and also what Angel Oak is not, and also sort of frame the issue that we are here to talk about today, which is really around concentration risk, particularly in community bank CRE portfolios. And then let's think solution-oriented. What are some of the things that can be done? And some of these will be obvious solutions, but hopefully some of them will be something that will stimulate your thinking in a new direction. And at the end, sort of summarize, and there's some biographical information about me as well. As far as Angel Oak is a family of companies and really started around our capital advisor, registered investment advisor, Angel Oak Capital Advisors. Started in 2008 during the crisis with a little bit of friends and family money. Has since grown to a investment portfolio and a complex of different structures where we manage about $6 billion in total assets. A lot of those assets are actually banking related. We're very heavily invested in housing and real estate related assets such as mortgage-backed securities, commercial mortgage-backed securities, We also have a broader structured credit fixed income exposure in those funds. In addition, we have a mortgage banking subsidiary, Angel Oak Home Loans, which is a full-service mortgage company, and we focus on the generation of both qualifying and non-qualifying mortgages. So we do have not only that line of business, but also insights into the market from that business. And then we also have the consulting group, and I'm a part of the consulting team. Angel Oak Consulting Group is really a consultancy that works with primarily community banks to help them deal with their risk management issues. We focus on a number of different risk management areas, such as interest rate and asset liability management, interest rate risk management, market risk management, credit risk management, liquidity risk management. So if there's risk and it's at a community bank, we like to think that we have some helpful strategies that we can work with you on. Let me tell you a little bit about what we are not, though. We are not an investment bank, and we do not help banks to access the capital markets. We do not design capitalization strategies and introduce banks to capital. So we don't receive any sort of fees, commissions, or other revenue that are associated with any sort of issuances of bank capital. So I just wanted to make that point very clear because I wanted everyone to understand that our interests are aligned in this presentation. We're here just to talk about ideas, and we don't particularly benefit from a bank implementing any one strategy over another. Our focus really will be around how to deal with concentration risk. So let's get into the heart of the presentation. And how we deal with this will involve a number of different potential solutions, but some of them involving, obviously, the implications for bank capital. So I think we all have a pretty good sense of what concentration risk is. And it tends to be one of the areas where banks get into trouble, especially in a crisis, because in a crisis, values tend to become very strongly correlated and also pointed in a downward direction. And that's really the risk of concentration. If you don't have a decent amount of diversification, you're going to get in trouble in a number of different respects. And banks have proven that thesis time and time again over the decades, whether it was in energy lending, leveraged loans, the commercial debt obligations during the financial crisis, counterparty credit risk associated with certain types of counterparties in trading and market-oriented transactions. There have been various waves of emerging market and sovereign risk issues when banks have extended credit to sovereign entities. Loan participations, there have been cycles of agricultural lending issues when commodities prices have worked against banks, and then also commercial real estate loans. And CRE tends to be the area that continues to jump up and attack banks from all directions, especially when they least need it, when we're facing some kind of a crisis in particular. So what can we do to maybe deal with some of these concentration issues, particularly because commercial real estate is once again becoming a key factor that examiners are targeting in on, and I know bank management is focused in on as well. We have a lot of conversations both with the regulatory community. I am like what we like to call a recovering regulator. I was at the Fed for 12 years, but I've been outside the Fed system, but still having conversations with those resources to talk about what their concerns are. And at the community bank level, I think it's fair to say that concentrations in commercial real estate are probably one of their biggest concerns. And the definition of concentration risk is really relatively well defined from a regulatory perspective. It's when any exposure that has common features exceeds 25% of the bank's Tier 1 risk-based capital and the allowance for loan and lease losses. So relatively good indication of what the regulators are looking at, and it's easy to build a test that can monitor that at your institutions to make sure that you're not bumping up against any regulatory concerns. But speaking of regulatory concerns, if you track the development of commercial real estate lending throughout the pre-crisis period, starting at about 2000, you can see that there's been substantial growth in those exposures, and since 2000 up until the crisis period in particular. Now, I wanted to mention that obviously the regulators were not completely asleep at the wheel. They realized that these exposures were present, and they took efforts to provide some guidance to help banks to be able to adjust their positions and be able to perhaps move away from some of the concentrations that they were facing. So leading up to the crisis, there was some guidance that was provided, but obviously, as we'll see on the next couple of slides, there have been some substantial issues that are associated with the performance of commercial real estate. and I know that that's not news to anyone. On the slide that we're looking at right now, basically we have a formal definition of what the supervisory guidance is. This was released at the end of 2006, so just in time for the crisis. You know, it was pretty clear that the regulators were concerned about these concentrations leading into the crisis. And a lot of people, especially those of us that might have seen the movie The Big Short, think about the crisis as being associated with subprime mortgage lending and some of the credit default swap transactions and other issues that certainly were important and had systemic implications. But if you think about what really damaged community banks, it wasn't these esoteric transactions in credit derivatives or even so much in subprime mortgage investments, but rather in commercial real estate. So even prior to the height of the crisis, the regulators had promoted certain benchmarks and considerations that they would look at either off-site through surveillance or when they were on-site conducting an exam that would indicate their concern around commercial real estate concentration risk. So I'm not going to read to you the regulatory requirements, but essentially if the specific types of lending in construction, land development, and other exceeds 100% of capital, and then total real estate is either a substantial position, 300% of total capital, or is growing substantially. You know, those are red flags to the regulators. So I'm sure most of you, or I'm certainly actually all of you, have tests in place that are monitoring these regulatory concerns and are probably driving decisioning on the lending side too as well. What do we do in terms of incremental lending decisions if we are bumping up against some of these limits? And there's a lot of other guidance that is available as well, but it's important to remember that this is guidance, and the December 2006 guidance did not define specific real estate concentration measures or establish lending limits. That was left up to the banks to internally develop their own risk limits. So the regulators continue to expect banks to manage within their own limit structure. Well, as a consequence of the crisis, you know, leading up to the crisis, there were a lot of concentrations, and of course, a lot of pain was experienced in commercial real estate portfolios, and primarily in the ADC loan category. So you can see that the losses experienced and the charge-offs experienced in that particular category of commercial real estate were multiples of the other different categories, but the pain was pretty widespread. And so this was definitely one of the biggest problems that the community banks experienced during the crisis, as opposed to some of the larger Wall Street type firms that were involved in much more complex transactions. And the FDIC did a little bit of a debrief and went back and looked in 2012 at what some of the stronger practices were at institutions that actually were successfully able to manage the risk in these portfolios. And there were a number of different factors that really led to success, you know, mitigating the risk or reducing the pain that was experienced. The pain was pretty widespread, but certain banks did a better job of mitigating these risks than others. And really the factors were just doing core banking business well, conservative growth strategies, not trying to grow too quickly or out of your footprint, relying on core deposits as opposed to hot money for funding. Obviously, prudent underwriting standards, not getting involved in speculative lending activities, responding to supervisory recommendations. Obviously, the FDIC loves to think that the banks are trying as hard as they can to do that. And then finally, also maintaining stable capital levels and, importantly, access to additional capital. So the community banks that were successful at being able to access capital were the ones that were able to weather the storm of the financial crisis and emerge on the other side in the best condition. So I want to keep that observation in mind as we are beginning to discuss what some of the current issues are in commercial real estate lending, and then potentially what are some of the solutions that we could pursue to ensure that we don't run into the same problems that we ran into in the financial crisis. Now, clearly, the next crisis is not going to be driven by the same factors that caused 2008, 2009 to occur. So we need to be on the lookout for other drivers of risk. But at the same time, the exposures in commercial real estate are probably going to be where the highest likelihood of pain being felt is going to show up. So some of the current issues that are really evolving in commercial real estate lending in general, larger domestic banks have been pulling back to a certain extent in terms of lending in commercial real estate. And part of the reason is not that there's not demand on the borrowing side. Borrowers are still looking for funds, and projects are still looking for sources of funding to move forward or to refinance existing projects. But the problem is that the large banks have historically downstreamed a lot of their exposure by participating out some of the risk to smaller banks in smaller pieces. So, for instance, a $500 million loan might be chunked up into $25 million exposures and then pushed downstream to a consortium of banks that would be willing to bear that risk. But as most of us are, I'm sure, aware, a lot of these smaller banks, smaller lenders are bumping up against these regulatory guidelines, maybe not strict limits, but guidance for commercial real estate loans. And regulators have a way of creating pain for banks that exceed that guidance. As we'll see in just a little bit, there is data that says a lot of banks have exceeded those thresholds, those target benchmarks that the regulators have established. So those aren't drop-dead limits, those aren't code red limits, but they certainly do attract the regulatory attention, and I'm sure they're also attracting the attention of senior management and the boards at a lot of these institutions. And the upshot of this outcome for community banks is if they aren't getting downstream business from upstream correspondent banks, and if they're not able to lend in their own footprint because they're bumping up against these limits, not only does that constrain their ability to make commercial real estate loans, which are in many instances their best yielding asset, but also it constrains their overall growth prospects, their ability to succeed, expand, become larger, and survive. Because a lot of us are aware that becoming larger and having a growth strategy and getting over a certain asset threshold is a critical success factor in today's market. If for no other reason than just to be able to spread around the increased compliance costs that Dodd-Frank and other regulations have created. So the concern is that if this condition continues, that there could be a decline in the number of bank charters. That is, banks will be forced to either merge with other institutions or turn in the keys in a lot of instances because it just doesn't make sense anymore for them to operate as a community bank below a certain asset size threshold. So a no-growth strategy is not a long-term strategy. And also, there's clear indication that the demand for commercial real estate lending continues because a lot of foreign banks or U.S. offices of foreign banks have stepped in to take up some of this slack. And in 2015, there were substantial investments by foreign offices, U.S. offices of foreign banks to pick up some of this slack. So the overall picture is that the demand for financing for commercial real estate is strong. And it is one of the best yielding assets that a community bank can invest in. And yet they're facing these structural constraints. That is, that the lending limits are starting to stare them down. Some of the other things that we should be sensitive to are that there have been some changes over the past couple of years with regard to the Basel risk-based capital requirements and also some of the capital treatment under Dodd-Frank. So commercial real estate, depending on which category it falls into, can be treated very differently than it was in the past under previous regulatory regimes. And some of the loans, including the ADC loans that are not extremely conservatively underwritten, have even higher risk weights than they did before with regard to establishing risk-based capital requirements. So these factors are all weighing in on banks as they are looking out at the environment and trying to figure out what to do with regard to commercial real estate. Well, one thing that's happening is that commercial property values continue to increase, and I've included some index information that is aggregate information across the U.S. and current through the third quarter of 2016. So clearly commercial real estate prices continue to rise, and if that's going to continue to be the case, then that points to opportunities in this space for banks that can find room on their balance sheets and have supportive capital structures that can facilitate this kind of lending going forward. So the demand is there, and the collateral values are supportive of this kind of lending going forward. But how do we solve some of the problems that many institutions have? And I've included some very public information that I obtained from SNL, S&P Global Market Intelligence, simply a download of the institutions that are exceeding the regulatory guidelines that I mentioned earlier. And so on a asset size basis, I've ranked from top to bottom the banks that are on the list of institutions that that are concentrated in commercial real estate as determined by the regulatory community. So I'm not saying that these 20 banks that I've indicated are the only banks. Certainly they're not. There are hundreds of other banks that are exceeding these regulatory limits. In addition, these banks are ranked by total asset size. So the banks that are at the top of this list aren't the worst, are not exceeding these guidelines the highest necessarily. What I wanted to give was a sense of the size of the issue across the system, and ranking them by total assets gives you a sense of the total percentage of the banking market that is in some way out of compliance with the regulatory guidelines. So keep in mind that when this happens, when these regulatory guidelines are exceeded, the regulators don't show up the next day and lock all the doors and send everyone home, but certainly that translates into increased regulatory scrutiny. So we can acknowledge that there's an issue, that the banks are running up against concentration limits both from their internal risk management perspective and also from the external regulatory guideline perspective. And so what can be done about this? Well, one thing to do is to turn your engine off and to idle for a while and give up on the opportunity to book assets that are some of the most attractive and highest yielding assets in an environment where banks are obviously starved for yield. You know, the alternatives and the yields associated with them are not very strong in this low rate environment. Now, obviously, rates are trending upwards currently, and so that might change, but nevertheless, it seems a shame to leave this opportunity sitting on the table. And also, if you're not growing your commercial real estate portfolio, you're probably not growing if you're the majority of community banks, and that sets you up for lower profitability and potential for getting acquired, especially if you have some sort of adverse event that temporarily diminishes earnings or stock price that can make you a likely buyout target when you might not have that in mind as a strategy. So let's think solution-oriented. What are some of the things that community banks could contemplate if they wanted to alleviate some of these concentration risk issues? So I've basically broken up the solutions component of this presentation into two segments. What I want to call off-balance sheet strategies and on-balance sheet strategies. So basically, not necessarily using like a contingent line of credit or something that we traditionally consider to be off-balance sheet, but rather getting the assets off your balance sheet in one form or another, and thereby freeing up capital. So we'll talk about a couple of those alternative strategies, and then talk about how we can move forward while continuing to keep most of our commercial real estate assets on our balance sheets. So the off-balance sheet strategies basically fall out into three categories, and I'll describe what is involved in each of them and then some of the upside and downside of each of these approaches. Whole loan sales, securitization, and then entering into a kind of what is sometimes called a mezzanine finance strategy or a unitranche lending program, where a certain portion of the commercial real estate credit is released to a third party. Let's take a look at some of these ideas. So loan sales and securitization are pretty similar strategies from the perspective of the community bank that is putting these assets up for either sale or securitization, because they're ultimately going to end up off the bank's balance sheet in exchange for cash. And the attraction for this strategy, obviously, is that you're freeing up capital and freeing up cash to keep the engine running on commercial real estate. And there are a lot of firms, brokerage firms, loan servicers, that maintain trading desks for commercial real estate. So they know the market for a variety of different types of loans, performing, non-performing, scratch and dent, loans that don't fit the CMBS underwriting box, loans that are a little outside the credit box for standard underwriting requirements to fall into a CMBS type of a transaction. There's a pretty active secondary market in whole loan sales that has become more active and more liquid over the past couple of years. In a lot of instances, whole loans have been in some ways more attractive recently than securitizations, because in some ways you're cutting out the middleman, you're cutting out the manager, the servicer, the trustee in a securitization, and an investor in a whole loan is getting the entire return for the most part, probably with some portion of their return paid to a servicer at some level. But in any event, there are a number of different avenues where a bank can engage the services of a third party or even identify buyers themselves for their commercial real estate assets and get fairly decent prices for them. The pricing is pretty well established, and that's an indication of how much liquidity there is in the market for these various loan categories. Obviously, the agencies also have conduit programs. Fannie Mae and Freddie Mac have the DUS and K conduit programs. So if you're a multifamily lender, that's another avenue that you can become a basically platform lender for Fannie or Freddie for the agency commercial real estate securitizations that they put together. I mentioned securitization as a solution, and interestingly, for most community banks, the CMBS market, the commercial mortgage-backed securities market, is usually not a consistent takeout for community bank CRE loans. The reason being primarily that community banks focus on small balance or small dollar commercial real estate loans. And the sweet spot for that kind of lending is usually between about $1 million to $10 million. Obviously, those boundaries can go up and down, but that's the sweet spot. Whereas CMBS is really looking for loan sizes of $10 million and up. In fact, their sweet spot really is probably $50 million in loan size and up from there. So in some ways, the basic community bank commercial real estate lending underwriting box doesn't fit the CMBS underwriting requirements. Now, of course, the markets are adapting to this because the community banks have been recognized as being at capacity for some time, and there are a number of people who are trying to come up with a model to permit securitization for some of these small balance community bank commercial real estate loans. There have been a couple of companies, Velocity and ReadyCap, come to mind, which have been successful in securitizing their own origination primarily. So these are not aggregators. These are basically firms that are non-bank entities that are securitizing their own production, but it is very community bank-like assets, small balance commercial deals, and they've been successful in floating these to the marketplace. Relatively small issues compared to a typical issue in this CMBS market, so in the $1 to $2 million asset size total for the deals. But a couple of these deals have come to market, and what that says is there's some investor appetite for this kind of paper. So going forward, maybe the securitization underwriting box will widen a little bit, and community banks will be able to create conduits for their assets into securitization. Another approach that banks have been engaging in for some time is really looking at a kind of mezzanine financing strategy involving an A-B note type of structure. So in the illustration on the current slide, if you look on the left-hand side, the typical commercial real estate project that's going to be financed by a bank, they generally like to do recourse lending, and there's usually a 75% loan-to-value kind of a cutoff where they want to see about 25% in equity from the developer. And a lot of the interesting market-based developments are that there are non-banks that are willing to lend on much more generous terms than most community banks are with regard to making non-recourse loans with much higher loan-to-values associated with them. Loan-to-values of up to 85% that most banks wouldn't be willing to touch, just is outside of their underwriting box. So in order for banks to be able to compete against these non-bank or shadow bank lenders, they need to be creative to some extent. And one solution is to create a A-note, B-note type structure where there is an equity participation from the developer. It's a little bit smaller than under a typical project construct. And the bank partners with another source of funding to create what is called unitranche lending. So essentially the borrower is seeing one credit with one rate that ultimately ends up being a blended rate that is being paid to the bank and also to the third-party funding source. And the A-note piece, which is the safer piece in a sense, and lower yielding piece, is retained by the bank. And the B-note, which is really a first loss position in the unitranche structure, is funded by a third party, usually a hedge fund, a private equity fund, a specialty investor in this. There are some insurance companies that get involved in this business as well, although insurance companies tend to prefer to get access to the A-note component because of their risk profile. But there are a number of market participants that can serve as a takeout for the B-note and provide that level of funding. And why are they getting a higher level of return? Because they're in the first loss position as far as the credit is concerned. The developers, obviously, the equity position takes the absolute first loss, but if there are any default issues on the note, then the B note is going to take those losses first. So what this permits is it permits the community banks to continue lending in this space to more clients. They're not making maybe as large a loan as they would have in the past, but it certainly fits their underwriting box, and they're able to lay off the highest risk position in this. And when they're doing that, they're creating credits that are safer, less risk, and therefore generally in aggregate have lower capital requirements or more favorable capital treatment than the typical kind of lending that they've engaged in the past. So that's certainly one approach. It does involve partnering and with a third party, and it does involve obviously developing a program around this and educating your loan officers about this program. And it also requires that you can price out the risk appropriately so that the yield on the unitranche credit is compensating both you and the third-party funder for taking the risks in this type of a structure. So some community banks have appetite for that much structural complexity, and others don't. If we summarize on the off-balance sheet strategies, really what are the benefits? Obviously that we're getting some liquidity, especially if we're selling assets, to fund new loan origination so we can keep the engine running. And it does free up some balance sheet and some capital for other transactions, obviously for additional commercial real estate lending or for any other activity that the bank wants to use its capital and cash for. It does turn down the volume on the concerns that the regulators have, and also that internally we have as risk managers around the concentration issues. It does tend to address some of those concerns by deleveraging some of those assets off the balance sheet. And there's a possibility that although the assets are leaving the balance sheet, the customer relationships can be preserved pretty strongly, because a lot of times community banks are dealing with the same borrowers over and over. There's a relationship there, and you don't want to lose that. And many banks can arrange a situation where even though they may be selling an asset, they can retain the servicing and remain the face of the loan to that customer. And then there's also the possibility of a gain on the transaction. I know banks aren't in the business of creating loans to trade them and necessarily to make money on the trading of loans, but there could be a gain depending on investor appetite. The drawbacks are that there can be commissions for selling certain of these assets or creating some of these structures that are necessary. And also a lot of the loans may need to be sold servicing released, which means that you are losing as a bank that servicing income that you could have captured in the past if you have a servicing operation developed. And that also leads to the risk of diminishing your existing client relationships. How do you tell your best client that you have too much risk with them and you're laying off some of that risk to a third party? There's also the risk of adverse selection, because there's a tendency to sell your best loans to create the best cash flows and potential gains, but that leads you with an adverse selection of lower quality assets on the balance sheet. So that's something to watch for. And then there's always the potential that you might have to book a loss on a transaction like that. So those are all transactions that certainly are viable, but have their downside risk as well. Let's shift gears a little bit and think about some on-balance sheet type strategies. And we'll talk about two primarily: one, credit risk transfer transactions, and then the other, which is probably a little bit more in the middle of the fairway for a lot of community banks, which is the issuance of new capital, and talk about some of the strengths and benefits of those approaches as well. At a very high level, credit risk transfer transactions are ways of deleveraging risk off the balance sheet without fundamentally altering the asset liability structure of the balance sheet. And in particular, with reference to commercial real estate, it would involve a transaction that would diminish some of the risk associated with those assets without having to remove them from the balance sheet and without having to lose those relationships. So credit risk transfer transactions are generally found in the form of a credit default swap. So I referenced the movie The Big Short earlier, and if you haven't seen it, I would recommend that you do so. I took my wife, who has relatively little financial knowledge, and the whole movie made sense to her. It's pitched at a broad audience and really drives home some of the concerns that were rightly expressed around certain types of risk transfer transactions like credit default swaps. And the issue with AIG, I'm sure, leaps to mind for a lot of people, and I'm sure there are a lot of board of directors who have seen the movie and remember what happened with the bailout of AIG and their association with credit default swaps. But just to describe at a high level what a credit risk transfer transaction is involving a CDS or a credit default swap, the easiest way to think about it is taking out insurance by paying a premium to a protection seller, like an insurance company, sometimes literally an insurance company, but someone acting like an insurance company, for instance, another financial institution. And in this instance, you would be referencing an asset that you had concerns about that might go into default or that might have too much risk by some metric. And if there is some sort of contingent event, the protection seller, we can think about them as the insurer, they make a contingent payment, whether it's a default or whether it's a significant decline in the value of the asset. There is some sort of compensation for losses associated with credit risk. And that's the easiest way to understand what a credit risk transfer transaction is. Now, there are other types of transactions as well, for instance, getting a third-party letter of credit. These are all transactions that are actually supported under the Basel III risk-based capital regime and also supported under current U.S. regulation. That is, it is possible to enter into credit default swap or credit insurance-like transactions and transfer risk off of the balance sheet to a third party. However, given the developments during the crisis, the regulatory treatment of these transactions is pretty onerous. That is, there is a lot involved in order to be able to use these types of transactions to transfer the risk away from the balance sheet. If you are able to do that, though, essentially, if you can transfer the risk of your balance sheet assets to a third party, that basically frees up capital that was supporting those assets, and that capital can then be used to support lending in other areas or investments in other areas. So this is a type of transaction that is supported by the current regulatory regime, and we also see certain institutions that are engaged in these types of transactions. Obviously, when you think about credit default swaps, you start to think about some of the larger institutions, but there are smaller institutions that are engaged in credit default swaps, or what we'll call CRT transactions. Not a lot of banks, it is accurate to say, and especially not a lot of small banks. But if you look at the chart in the upper left hand of the current slide, you can see that there are sort of three tiers of banks: 250 billion and above, 50 to 250 billion, and 0 to 50 billion. And in that smaller asset tier, there are a number of banks, albeit a small number of banks, that have engaged since the crisis in some of these CRT transactions. And that number is trending upwards. Now, granted, it's a small number of institutions. In 2014 to 15, the number of institutions that we got data for was 8, not a big number compared to the 6,200 or so remaining bank charters that are out there. But it's interesting to see that trend line going up. And the bottom right-hand chart is a little challenging to read, but it essentially quantifies the amount of capital reduction that the banks were able to achieve by entering into these CRT transactions or credit default swaps. So they were saving on average somewhere between 30 to 70 basis points of capital, and that's a substantial capital savings. So that makes these transactions look attractive in terms of being able to continue to expand your commercial real estate activities, but there's always a but. There are many challenges to these types of transactions. We're essentially talking about developing a derivative strategy, and there are a lot of risk issues associated with a derivative strategy. First of all, who are your counterparties in these transactions? In many instances, some of these transactions are exchange traded, which mitigates some of the concerns, but any kind of bilateral transaction with another bank or other financial institution would certainly introduce direct counterparty risk. And then even if it is a transaction that is cleared on a central clearing platform or exchange, there are new requirements under Dodd-Frank that these transactions have to have margin requirements. That is, margin or collateral has to be posted frequently against these transactions. Now, it is true that smaller banks are frequently exempted from some of the Dodd-Frank requirements, strictly speaking. But from a practical perspective, generally, your counterparties that are going to facilitate these types of transactions will require margin, which means that you have to have maintenance procedures to maintain that margin. Assets have to be marked to market on a frequent basis, and of course you're incurring the opportunity cost of those margin balances. There are extensive record-keeping requirements around any type of derivative transaction, including credit default swaps. There are FASB hedge accounting treatments that require mark-to-market, which introduces potential earnings volatility. If you are able to avoid that earnings volatility by demonstrating effective hedging strategies and effective risk reduction, nevertheless, those hedge effective testing requirements are very extensive and quantitative and require a lot of resources. Obviously, there's an educational effort for senior management and for the board in particular, as far as what the strategy is, what is involved. And I know many banks, many boards, many senior managers are allergic to the D word, to derivatives altogether. So any education process obviously has to be extensive. And then finally, a derivative solution is going to attract a lot of regulatory attention. While these are permissible transactions, clearly your institution is going to have some serious conversations with your regulator to make sure that they see this as a viable as well as permissible strategy. And it's certainly going to create more attention from an off-site surveillance perspective, as well as on exams. You know that those types of transactions are going to receive a great deal of scrutiny. So with that being the case, and also keeping in mind that there are other regulatory implications as well, primarily those that require banks to increase their overall level of capital, both Basel III and as well the Dodd-Frank specifically for domestic U.S. banks. Those two regulatory regimes have had an enormous impact on capital requirements and other requirements as well for banking institutions of all sizes, but including certainly community banks. And of course, complying with some of these additional regulatory requirements has been one of the biggest drag on earnings for community banks. So capital is a very real consideration, and the way to think about pre-crisis versus post-crisis from a capital perspective is that now banks have to have more and better capital. That's basically a summary of the new capital requirements. And there are ways that banks have addressed raising capital in the past, and we'll talk about a couple of those strategies, but then think about which strategies are probably best in the current environment. For instance, prior to the financial crisis, a lot of banks took advantage of the opportunity to issue trust preferred securities, which were a type of hybrid capital instrument, and they were meeting capital requirements that allowed them to qualify for Tier 1 capital treatment. And so about $70 billion in total of TRUPS were issued in the pre-crisis period. A lot of issues came up with those issues with the TRUPS preferred securities that were issued, primarily because a lot of banks were in financial distress and began deferring payments on the dividends, which are really a kind of interest payment on these longer-term capital instruments. And as a result, investors felt in many ways burned by that investment. So investment capital was not as readily available to community banks in particular because they were big issues of trust preferreds. And when they became non-performing from the investor's perspective, that meant that there was another avenue of capital that was not available to community banks. But more importantly, also, the implementation of Dodd-Frank basically took away the favorable Tier 1 capital treatment for the vast majority of TRUP issuances, certainly for new issue. So while there were some grandfathering provisions for trust preferred securities, most of the new issue of trust preferreds would not have qualified for Tier 1. So that avenue for community banks to raise additional capital basically just disappeared. And there were some other alternative capitalization strategies available to banks, which were largely a consequence of the financial crisis. And I'm thinking particularly of the Treasury's TARP, Trouble Asset Relief Program, and the Small Business Lending Fund, the SBLF. And a lot of community banks issued TARP and SBLF that helped them to recapitalize. And initially, those sources of funds or sources of capital were at very favorable rates, but the Treasury had no intention of this serving as a capital source into perpetuity. So there was a reset date on the, I guess, dividends, if you want to call them, or payments that were associated with these funding sources, many of which have now jumped up to about 9%, which is above market for most community banks in terms of funding. So let's think about another strategy that could help resolve both the capital requirement issues that banks are faced with and then also these concentration risk issues. So larger banks, since the crisis, have been able to access the capital markets, particularly directly in the capital markets for large issuances of senior debt with wholesale institutional investors. So even relatively shortly after the crisis, the large global SIFIs, or systemically important financial institutions, were able to pretty easily access the capital markets for debt in particular, primarily by issuing senior debt. But that was not the same for community banks. The community bank model was seen as being very threatened, and investors were just not pursuing that opportunity. So what were the alternatives that were really available to banks? Well, once TRUPS disappeared, the other kind of capital instrument that was viable and available and attractive to broaden your capital base was the issuance of subordinated debt, long-term debt subordinated to any senior issuances that met certain stringent regulatory requirements to qualify as Tier 2 capital. So in the post-crisis period, the issuance of community bank, in particular sub-debt, has increased significantly. And in all honesty, it's because it's one of the few sources of capital that are available to community banks. What are the attractions of issuing sub-debt? Well, one, the proceeds, if they adhere to the regulatory requirements, are classified as Tier 2 capital and satisfy the enhanced capital requirements, especially the capital ratios for total risk-based capital and others. Sub-debt does not dilute existing shareholders. A lot of community banks are relatively closely held, and the ownership structure does not want to give up control. So that takes away the ability for these banks to issue additional common equity. Plus, it's been very difficult for community banks to attract equity investors in the first place outside of their core footprint. And the interest payments are tax deductible because they are interest and not dividends. One of the uses of this, agnostic to what impacts it might have for commercial real estate lending, but certainly it can be used to pay off TARP and SBLF debt. Recall that a lot of this is repricing to about 9% per annum. And Angel Oak is a relatively active investor in the bank sub-debt space. So while we do not engage in capital raising for banks, we are active investors in bank sub-debt. And just surveying the market for bank sub-debt, we would say that roughly speaking, the weighted average coupon of bank sub-debt is somewhere in the 6% range. That can drift upwards or downwards depending on the size of the deal and the size of the issuer. But for most of the issues outstanding, that coupon is averaging about 6%. So that's a lot more attractive than the reset price of the TARP and SBLF debt. Have banks been taking advantage of this opportunity? Yes, they have. And the current slide is showing some data that we obtained from SNL that shows capital issuance, new issuance of capital year to year from 2010 through 2016. And the upper left-hand diagram is all banks, new capital raised by all banks in the U.S. And the preponderance of that is in the form of senior debt. So the reason that the preponderance of the new capital raising has been in senior debt is because most of the big banks, the global systemically important institutions, can access those markets and can get pretty favorable funding on senior debt. So they've been big issuers of that. But I think it's more interesting for us to think about what are the opportunities for community banks. And if we look at the graph on the lower part of the slide, what we see is the percentage of capital that is raised by banks that have less than $10 billion in total assets. So that's a relatively arbitrary definition of a community bank that has less than $10 billion in total assets. But you can see the composition of capital that has been issued. And the interesting story here is that obviously community banks are not big issuers of senior debt. And also the common equity has not in recent years been the driving factor of the way that banks have tried to raise capital. But what's really been growing and becoming a much more important component of a bank's capital structure is subordinated debt. And again, for some of the reasons that I mentioned earlier, banks are finding this to be a very attractive source of capital because it can be used to pay off more expensive TARP debt and SBLF debt. But certainly also it can just, at the end of the day, increase your overall capital base. What does a deal look like? What does a transaction look like? Usually the securities are typically a 10-year with a 5-year non-call component. This is generally to adhere to the regulatory requirements that Tier 2 capital isn't callable for at least 5 years. They're generally quarterly pay, fixed rate, and then they convert to floating after 5 years tied to 3-month LIBOR. And the deal sizes themselves, that is for a particular capital raise, one bank's issuance of sub-debt can range from about $5 million to up to $100 million and even more for some of the larger community banking institutions. So there has been pretty active issuance, and that issuance has been increasing. The overall size of the sub-debt market slowed down in the U.S. in 2016 slightly, but sub-debt issuance for banks under $10 billion actually increased, and that's really the kind of institution that we're trying to address risk factors for in this discussion. So to get a sense of the benefit that is obtained by issuing new capital, I just included some numbers here that gross up the dollar of capital and how much lending it can support. I know there are a number of other factors that would adjust some of these numbers, other capital requirements that would come into play. But if you think about the kinds of commercial real estate lending that you can engage in and the different risk weights under the risk-based capital requirements, you can see that $1 of capital can have a multiple of up to 25 times, or that is $1 of capital can be used to support $25 in additional lending, particularly in the multifamily, very stringently underwritten assets. So that benefit is not quite as great for some of the riskier assets like the high volatility commercial real estate. That's a new category that has been promoted under the new regulatory regime. And I think that the risk weighting there is certainly intended to, in some ways, discourage banks from getting too heavily concentrated in those kinds of lending. But you can see for the broad category of commercial real estate assets that $1 of capital can go a long way in supporting additional lending activities and helping to keep that commercial real estate lending engine running. Now, it's not a walk in the park, obviously, to issue new capital, so there are some very stringent requirements around receiving Tier 2 capital treatment. Just to summarize this list of relatively dry regulatory requirements, though, the idea is that for this to be capital, it needs to be a relatively long-term instrument, and so not callable in the near term. There should be no intention to call that in, or there should be no communication that the bank intends to call it in at the end of the call period at issue, although the bank does have the ability to call that debt in under certain circumstances. The note should not be credit sensitive in any sense, in the sense that it is adjusted for its yield is adjusted for the bank's credit rating or credit standing. So there are a number of different requirements in terms of structuring an issue that a bank would have to adhere to be able to ensure that they were receiving favorable Tier 2 capital treatment in some of these notes. But the structuring is relatively well understood. There's been significant issue of bank subordinated debt. In particular, there's been significant issue across the country in community bank sub-debt. We have seen a lot of these deals come to market. We have a lot of conversations with banks that are contemplating new issues. We have conversations with investment banks that are facilitating these deals. And these are broadly distributed interest in issuance across the country, across different economic areas, across different regions. So it's not any particular type of bank or any type of region that is concentrated in issuing these securities. So to summarize, really we started out by talking about the issue of concentration and how it was constraining community bank profitability, right? Because if banks can't make commercial real estate loans, they're unable to take advantage of one of their highest yielding assets, but also ultimately for the bank's survival strategy, it constrains their growth, their ability to grow and continue to be successful and be an aggregator and be a survivor under the current regulatory regime. And there are options for banks to delever commercial real estate assets off their balance sheet through loan sales, participations, and securitization, but that can damage the important core relationships that many banks have with their borrowers. It can also constrain your growth. You're getting cash for these transactions, but you're really net not increasing the size of the balance sheet. And getting help with some of these transactions can certainly cost you in terms of the commissions that are charged. There are some derivative strategies that are available in terms of credit risk transfer transactions, but as we discussed, many of those require complex infrastructure to implement and bring to the bank a new and different class of risks. So certainly, any bank contemplating that type of strategy needs to think fully through the implications of implementing a derivative trading program before entering into such a strategy. And then lastly, we talked about raising additional Tier 2 capital primarily through the issuance of bank subordinated debt. And that obviously solves our initial problem of being able to grow the CRE portfolio to keep that engine running. And again, this is one of the most profitable lines of business for community banks. It does allow the bank to grow, not only to grow just to become more profitable, but also to avoid being acquired. Now, let's face it, this is an acquire or be acquired kind of an environment, and any kind of growth is going to increase the probability that you are a survivor aggregator and not one of the aggregated. Also, certainly relative to some of the regulatory programs like TARP funding and SBLF funding, it's a more favorable cost of funds. Overall attractive coupons for long-term debt in general, and it's not dilutive to existing shareholders. So those are the major points that I wanted to raise, and we were targeting about an hour for our conversation, so it looks like we hit that mark. But before we do any kind of wrap-up, I would bounce this back to Carl and see if there were any comments, questions, or issues with the attendees that we needed to address.
No, thanks so much, Rob, and wow, you are a true professional, because right when my clock hit 3 o'clock, you had wrapped up, 3 o'clock Eastern. So thanks so much for the presentation. I am going to say, just in the interest of time, because I know everybody just doing enough of these, I know once we hit the hour, people start heading to other meetings. So what we will do is, after the call, either today or tomorrow, we'll make sure we get a copy of the slides to everybody, as well as a copy of the audio, because we have been recording. And we'll also provide you with Rob and his team's contact information if you'd like to learn more about the services that they offer and how they can help with primarily the raising of additional Tier 2 capital, as he described. So want to make sure that anybody that has an interest in working with Angel Oak can do that. So I'm going to go ahead and wrap it up. Thanks so much to Rob and Angel Oak. Hopefully we don't go as many years without doing this together. Thanks to all the folks that joined. If you want to learn more about Mountain Seed, I think you know how to find us. But I hope everybody has a great rest of the day. Thanks so much.